Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for our weekly review of the Nasdaq-100 Volatility Index, or VOLQ, is Scott Nations, President of Nations Indexes. Scott, it's great to have you with us as always on Trade Talks, and give us a high-level overview of VOLQ and what makes this methodology unique.
Sure, VOLQ is fascinating. Right now it's trading at about 2550. What does that tell us? What does that number mean? Well, it's the implied volatility for the Nasdaq-100. In other words, it's the amount of volatility we would expect over the next 30 days in the Nasdaq-100 index as the options express it. So we can look at the option prices that are trading, and we can do a little bit of math, and we can convert that into some sort of volatility measure. Really, it's the market's best estimate for how volatile the Nasdaq-100 will be, again, over the next 100 days. And the beautiful thing about this, Jill, is that we're actually looking at traded prices. So this is the market's best estimate for how volatile the Nasdaq-100 will be.
Scott, Nasdaq and CME Group recently announced that futures are due to list on October 5th. What will that allow traders to do?
It will allow traders to take a position in VOLQ. That is, if you want to hedge, because we know that over time, VOLQ tends to move inversely to the Nasdaq-100. So let's say that you have a portfolio that looks a lot like the Nasdaq-100, might have a bunch of the big names in the Nasdaq-100. You could hedge that by buying VOLQ futures, because we know historically that VOLQ tends, again, to move inversely to the Nasdaq-100. So if the Nasdaq-100 were to drop quite a bit, we would expect VOLQ to rally. So it's a great way to hedge a position if you have a portfolio that looks a lot like the Nasdaq-100.
And Scott, how can traders use VOLQ right now?
Jill, that's a great question, because everybody needs a little bit more information. And we know that we're not going to get the futures until about October 5th. So people can use VOLQ right now, again, as an estimate of how much volatility we're going to expect in the future. And if we do a little bit of math, we take that VOLQ level, about 2550, we divide by 3.5, which is about the square root of the number of months in a year. And we see that the market says that we would expect a range to the upside or to the downside of just over 7% during the next 30 days. And again, VOLQ is always going to respect a 30-day time frame. So we know that the market is saying we can expect a rally of less than 7%, or a break of less than 7% during the next 30 days. And importantly, the market knows, using a little bit of statistical work, the market is saying that that is the case with about 68% confidence. And so if somebody wants to implement an NDX option position, and they can do that math, and they can say, hey, the market is unlikely to get to this level or that level, and they can use that to inform their option strategy. And we know, Jill, everybody's looking for a little bit more information.
So even if you don't trade futures, it's just like any other option. It's just a good tool to have in your tool chest as you're reviewing the marketplace and trying to determine your risk levels and portfolio management and so forth.
That's right, Jill. Or let's say that you're thinking about putting on some sort of option position using NDX options. And again, that's a 68% confidence level. We can use that expected range and pick strike prices in NDX options that respect that expected range. And so that's how somebody could use VOLQ right now to inform their option strategies. And Jill, we know that everybody is desperate for a little bit more information, and this is how option traders in NDX can get a little bit more information.
All right, Scott, great stuff as always. Thanks for joining us on Trade Talks.
Thanks, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.